Thank you, Matt. And yes, good morning to those that are not on the East Coast. On the East Coast, we're already at noontime. So thank you for everyone for joining us across the country. Yeah, I'm Matt Queasley with Reserve Advisors. If you're not familiar with our firm, we've been doing reserve studies for 35 years. And we've learned that, a reserve study is really only a valuable tool if boards understand how to use it. And they can be lengthy, technical, difficult to translate into practical decisions. And that's why we take a different approach. Our reserve studies are comprehensive but easy to understand. We build them with your board and not just for your board. And we don't just simply deliver a report. We walk you through the recommendations and give you the board the confidence to prioritize projects and develop realistic funding plans and make informed decisions, all while communicating the why. And we're really, really pleased to have Jodi and Michelle joining us today to talk about why reserves matter so much to the government-sponsored entity of Fannie Mae. And I'll turn it over to you, Michelle, to do a quick intro, and then we'll let the star of the show, Jodi, take over from there.
Hi, everyone. As Matt mentioned, thank you so much for joining us. We are honored to have Jodi here with us today. My name is Michelle Baldry. I'm been with Reserve Advisors for 16 years now, and I'm located in the DC metro area. And had the pleasure of meeting Jodi at another conference. I guess that was last month. And I'm so excited for you guys to get to hear from her directly today. So thank you so much for being here, Jodi. I'll turn it over to you.
All right. Thank you, Matt and Michelle. I am very happy and very honored to be here with all of you today. I know that each and every one of you probably have 1,000 other things that you can be doing right now at this very moment. So I really appreciate you spending time with us this morning or this afternoon, wherever you happen to be located, to talk about some upcoming changes for mortgage eligibility for condo projects. Um, we'll cover a lot of information, but just before I get started on that, I'll give you a little bit of information about me. I am at Fannie Mae. I've been here for, 16 years now. I have been very active in the work that we do around requirements for lending and condo co-ops and PUDs for a number of years. And so we are recently making some changes to support both the financial and the physical sustainability of condo projects and co-op projects for that matter. And some of these have resulted in policy changes, and we'll talk about those here today. Before we get started, I do have a disclaimer to share. It's a typical disclaimer. I will share my screen and we won't spend a lot of time on that. But want to make sure that you see that important information. This disclaimer basically says that I will endeavor to give you all of the accurate information that we have about our policies and requirements, but we have official publications, including our Fannie Mae selling guide and servicing guide, as well as lender letters and announcements that have all of this information, and that is the source of truth. So without laboring on this point, I want to just share my screen and we'll talk a little bit about Fannie Mae because I think there are probably a number of you are curious, what does Fannie Mae do? You might think that we provide mortgages to consumers, but actually our role in the marketplace is a little different than that. We purchase mortgages from lenders. And then we bundle those into securities and sell them to investors. This promotes a healthy housing market because once we buy those mortgages from lenders, that means they have more money to be able to turn around and do more lending to consumers. So we play a really important role in the marketplace around that. And because of that, we also set standards for those lenders. And those are underwriting standards that we'll talk about in a little bit more detail. But if you think about getting a mortgage or a loan for your home, often you think, well, you have to qualify from a credit perspective. The homeowner has to be a good, has to be able to qualify to take on that debt. Often there's an appraisal to evaluate the adequacy of the property itself. And then when we lend in condo projects, we also require that lenders determine that the project itself is healthy and well managed and is on sound financial footing. And that's a little bit about what we'll address today in our session. Just to give you the size of Fannie Mae and the role in the marketplace, here are just a few facts on this slide that are from our 2025 book of business. And you'll see that we guarantee over $4 trillion in mortgages and well over 1 million households last year were supported by our efforts in buying or refinancing or renting their home in 2025. So that's a pretty big role in the marketplace, but we're not alone in this. There is another entity that also provides a similar role in the marketplace. That's Freddie Mac. They're not on the call today, but I will say that the requirements that we'll talk about today are aligned between Fannie Mae and Freddie Mac. And that is to help reduce friction for lenders and consumers that are seeking financing for condominium units. Matt, Michelle, anything you want to add here before I move on and talk a little bit about the underwriting requirements specific to condo eligibility?
Yes, yeah, thank you. And these numbers are quite astonishing. When I saw them, I was just kind of jaw hit the floor of how big and how many how many families are impacted by these mortgages, these loans. And so one of the comments, and thank you all for submitting some questions and things before as you registered, but one of the ones that came up a few times was, we're a luxury condo. We don't have we don't have anybody that has Fannie Mae mortgages. Why should we care? Why is this important to us? Could you comment on that, Jodi?
Sure, yeah. So it's surprising, but we actually do purchase a number of mortgages that are in luxury condos. Very often, someone purchasing into a luxury condo may put a significant down payment into their purchase transaction. Or if they're refinancing the same. And so they may have equity in that transaction. And so lenders may sell those loans to us. But even if they're not selling those loans to us, often other investors who are purchasing those loans related to luxury condos may be using some or all of our requirements as standards that they use for lending in those condo projects. And then beyond that, I would say a lot of what we'll talk about today really is about sound financial management. And luxury condos probably do care about that, just as any other condo project would care that their project is on sound financial footing.
Yeah, I'm glad you mentioned refinancing too, because I think people don't think about that. There could be refinancing that could be impacted by these as well. Thank you.
Mm-hmm. Yep. All right. Well, let's move on. You guys may be wondering, so what are the things that Fannie Mae typically looks at when we're talking about condo project eligibility? And again, we're not talking about qualifying the individual consumer, but really the project as a whole. And that is one of the key things that we're looking at, or that lenders are looking at when they're originating a mortgage that they intend to sell to Fannie Mae. And so we have a number of general requirements. So this is related to project classifications, new established projects, detached projects, attached projects, et cetera, as well as review types. And we'll talk a little bit about review types because that's one of the changes. We have a number of requirements around what we call ineligible characteristics. And these are things that the condo project must meet to be eligible. So, for example, we don't allow projects that have outstanding critical repairs. Critical repairs aren't the same as preventive maintenance. They really are critical issues in the project that would make a project ineligible. We can't, per our congressionally mandated charter, purchase commercial properties. So this impacts condos that may be have condotel characteristics, so that would be another ineligible characteristic. And there are many other requirements in that section of our selling guide that lenders are looking to determine compliance on. A big piece of what we're looking at is financial requirements. So this is budget, reserves, and other things, and we'll talk a lot about those today. And then there are insurance requirements, and we've recently made changes there as well that should actually reduce some friction in the marketplace. And if you're interested in learning about all of our requirements, we do have a number of selling guide references on the slide, and you can go out and search on the internet the Fannie Mae Single Family Selling Guide and dig into that if you're really curious about the details. But one thing that often comes up related to a lender approving a condo project is a questionnaire. And so very often lenders are using questionnaires to try to determine compliance with all of these requirements. And Fannie Mae technically does not require that the lender use a questionnaire, although we do publish a questionnaire that lenders can use. And many times lenders are using their own questionnaires because they may have requirements that they're seeking to fulfill outside of what's covered on our questionnaire. So you'll see them a lot of times when lenders are trying to determine eligibility. And they use them as a simple tool to try to validate sometimes up to 60 or more different kinds of requirements that they may have, that we may have related to the condo project. And I know, Matt, you may have gotten some questions related to the questionnaires or anything else that I should address on that issue before we move on.
Yeah, I mean, I know questionnaires and talking with managers and boards throughout the country that they can be a bit of a sore spot because there's so much information and some of it is asked many times in different ways. And in fact, we've even heard, some associations that are getting legal advice not to answer some of the questions completely in the questionnaire because it could expose that board or association to liability. So I don't think that was interesting that there isn't, a requirement from Fannie Mae to do that, but I think it's probably sounds like maybe the best advice is just for those associations to follow their independent attorney's advice on how to best answer those questionnaires and be able to get the information out there that is needed for those associations.
Yeah, I can't provide legal advice, and certainly associations should listen to their attorneys for legal advice. What I can say is that, again, a questionnaire is often the most efficient way for a lender to get the information they need to determine eligibility. They're not asking associations to complete the questionnaires just because everybody's got all the extra time on their hand to fill out another form. They really do serve a useful purpose in the lending process to help with the underwriting. And very often what lenders are being asked to confirm to determine Fannie Mae eligibility or other investor eligibility is information that only the condo association has. So they really are the source of that information. And the lender is looking to get some kind of documentation so that if an investor came back to them down the road to say, did you confirm that this requirement was met? They can produce that documentation. And very often, if a lender can't confirm compliance, that may mean they have to turn the loan down. And like I can think about a Fannie Mae requirement around critical repairs. For example, that if a lender can't confirm that there are no critical repairs in the project itself, then they cannot sell us that loan. They would have to do something else around that loan, and sometimes that means the lender chooses not to originate that loan. So it can have an impact in mortgage financing if the lender's not able to determine compliance. And that's why that questionnaire becomes such a key piece or part of the mortgage origination process. But certainly, projects have to work within their own bylaws and policies and legal advice, and we can't provide that on this call.
Yeah, of course. I think a lot of when it comes to those critical repairs, and that's a lot of what comes up, and a lot of times the board may not know for sure if there are critical repairs or not. So it's an unknown. One of the things I've seen successfully done, just anecdotally here, again, not advice, but specific advice, but that you could say, well, here's an engineering report, a study that we had done a few years ago. You can read it yourself and determine whether you think there's critical repairs that came from that or not, and certainly sometimes you can answer what you can answer, but you may not know today if there's another critical repair that's needed because it's been a few years. And so that, like, you're right, that I can certainly see how that would give a mortgage company pause, a lender pause on being able to accept that.
Yeah, I hear that. And Matt, you're spot on. If they have some kind of an inspection report, they can provide that. And that should help the lender understand if there are critical repairs. They may have questions about that. And they may follow up with the association or their property manager to understand it better. Sometimes the lender may ask for a reserve study. If you have a reserve study, they may look at that to try to understand, is there any, outstanding items that really have not been addressed for a very long time. Again, critical repairs, and we have a lot of information in our selling guide and FAQs, and we can provide more resources around that. That's not the same as preventive maintenance. Every single association, every single homeowner, whether you live in an association or not, will have preventive maintenance to do. Roofs age, they will need to be replaced. Trees need to be taken down. There's sometimes plumbing or other kinds of issues that need to be addressed just by way of preventive maintenance. And we certainly want to make sure that associations are taking care of that. But preventive maintenance is not something that would make a project ineligible. A critical repair would be, and that's not really the topic of our conversation today, but happy to come back another time and talk about critical repairs in more detail if your client base would find that valuable. But certainly,
we did get a question on that. Someone just asked if there's a way to differentiate between critical repairs versus major repair projects. I guess just a quick example potentially of what they're asking. If they know they need to replace the roof because of age and, they're scheduling to do that next year, would that be considered, I guess, a critical repair versus just a routine major project that they're handling?
That's typically going to be routine maintenance. Now, if your roof was scheduled to be repaired 5 years ago and you didn't do that work, and now there's water intrusion and other kinds of things happening because that roof repair or replacement was neglected, that might start to fall into the category of critical repairs. But if it's just routine replacement, that's routine maintenance. So you should be able to make that differentiation. I can think of a project I visited last year in Minneapolis, where I'm located. And on paper, it looked like there may be critical repairs because there was major facade work being done. But when we visited the project, what we learned was that it actually was routine maintenance. There was no outstanding issue. There's no water intrusion. This was just routine maintenance. They were actually taking the preventive step of replacing. I'm probably going to get the words wrong, but essentially the outside grouting in the facade. There's a technical term and I can't remember it at the moment, but really it was to ensure that facade remained water proof, and so water did not get into the building. And so it was regular preventive maintenance. There was no outstanding issue. It was just time to do that work because at some point in the future, they could run into trouble if they had not done that work. And so we were able to quickly determine that that was routine. So we definitely want projects to be doing that routine maintenance. In fact, I would always say, and this will probably make Michelle and Matt very happy to hear this, but best practice is for associations to get reserve studies, reserve in accordance with the reserve study, and do the routine maintenance as recommended by the reserve study. If you do that, chances are you're going to be able to maintain mortgage eligibility when we talk about the physical and financial soundness of a project. So,
Thank you
Michelle, I
so
think
much.
that's a great question, and I appreciate whoever asked that. Well, let's move on because we have made some policy changes that we want to talk about today because they do impact projects, and I want folks to have that information as well. And as we
Jodi?
talk about these, yep.
Sorry, before we move on, can I just ask one quick question related to kind of who this applies to? There was a question that came in. What about CICAA communities or non-for-profit act communities? I did Google, a quick Google, what CICAA is, and it's Common Interest Community Association Act. So it's essentially governing non-condominium homeowners.
Okay, that's a great question. So these policies that we're talking about today, which are related to budget and reserves, reserve studies, and review types, apply specifically to condo projects. So there are other projects that where there's homeowners associations, PUDs, planned unit developments. Often that looks like tract housing. These policies don't apply to those kinds of projects, though they may be best practices for those projects. We are talking specifically about projects that are legally organized as condominiums. So they may be incorporated under different kinds of regulatory frameworks at the state level. And so we'll sometimes see them as horizontal property regimes, but if that horizontal property regime is legally a condo, then these policies would apply. I hope that answers that question.
That's perfect.
Okay, good.
Thank you.
So thanks for asking that. Before we dive into the changes, I just want to give you a quick picture of why we're making the changes. So all of these changes really are to promote long-term homeownership and condo community sustainability. At Fannie Mae, we care a lot about those things. It's not just enough to afford to be able to get a mortgage, but we want those consumers to have a sustainable home ownership journey. We want them to be successful, and we want the communities that they're purchasing in to also be successful. And so as we talk about reserves, one of the things that we look at a lot is the importance of adequacy of the reserves, because that helps to reduce the risk of significant deferred maintenance or critical repairs. It also helps to reduce the risk of really large special assessments down the road. And so keep that in mind as we think about these changes. They really are about promoting and protecting homeowners and their homeownership journey and the communities that they are purchasing into. And so with that, the first change that we've made is around review processes, and lenders had a couple of different review options that they could use, and often they are using either a full review, a lender delegated full review, or a limited review. And under the limited review process, lenders did not have to obtain a budget or look at reserves. And that process is retiring with new loan applications in just a few weeks on August 3rd. What this means is that lenders will typically now be reviewing projects or underwriting projects under the lender delegated full review process. And in that process, they will be asking for budgets, and they'll be having to look at reserves and dues delinquencies and other kinds of things like that. So the practical implication is that if you are managing an association or you're the HOA, you may see more requests for the budgets, more requests to understand the reserves. And so lenders may be asking for that in addition to a questionnaire. So just keep that in mind. I'm not going to belabor this a lot because what I really want to get to is the question around reserve requirements. And this is really important right now because many communities are in the thick of starting to plan for their 2027 budget. As you're gathering information, this is really important for you to understand is that Fannie Mae is changing our reserve requirements for new loan applications beginning January 4th, 2027. So today, our reserve requirement is that the association has to budget for 10% of its annual assessment income to be set aside for reserves. So if they're looking to qualify a loan today, they're looking at that 10% threshold, and they're simply looking at the budget and saying, is there a reserve line item in the budget that is 10% or more of the annual assessment income? In January, that threshold changes to 15%. So the test will be that higher amount. And I have a slide that walks us through that, and I'll get to that slide in just a moment. But just keep that in mind. That changes in January. But even before we get to January, next month in August, on August 3rd, if an association is reserving less than our required threshold, so today that's 10%, and in January 15%, a lender may ask for a reserve study to justify something less than that minimum threshold. And so if they're looking at the reserve study beginning in August, the lender is going to have to confirm that the association is reserving. So they're actually putting that money away, that they're reserving in accordance with the highest recommended amount in the reserve study. And they cannot use baseline funding. If you're questioning, well, what is baseline funding? Baseline funding is a reserve methodology that allows the association to reserve to the point where that reserve amount can hit zero. And that's essentially living paycheck to paycheck. That doesn't make a lot of sense from a risk perspective. When you think about unexpected expenses that may come up, it's always great, best practice to have cushion in your reserve account to address any kind of unexpected or unanticipated expenses. And baseline funding simply doesn't give any cushion there for that association. So the practical implication of this piece is that if you're reserving less than 10% or in the future 15% of your annual assessment income, and you're needing to use the reserve study to qualify, your lender is going to be looking at that highest recommended amount in the reserve study. If that happens to be threshold funding, they're using that threshold amount in your reserve study. If you have a reserve study that uses multiple amounts, maybe it has baseline threshold and the fully funded recommendation, they're going to use that fully funded amount because typically that's going to be higher than the threshold. Now, Matt and Michelle, I am going to dig into some examples more on that 10 and 15% calculation, but I want to stop here and see if there are questions before I move on.
Some questions on the calculation, which I know we'll get to, but I'll just comment. There has been a number of questions that came in that says, and I'm glad I want to just emphasize the way you phrase this is you really only need the reserve study does not create an expectation to fund at a higher level than the 10 or 15%. So the reserve study is going to be examined and analyzed if you're looking for an exception to the 10 or 15% rule. It doesn't, because reserve studies, in our experience, it's very, very, very infrequent that it would come back that an association only needs 10 or 15%. That's very, very much on the low end. Probably 90% of our associations require more than 15% of the budget going into the reserves. And so we're often recommending 20, 30%, depending on the association. And I just want to be clear that that does not now create that expectation from Fannie Mae's end, at least, that the association's funding at that higher level identified in the reserve study. Not that it's not a best practice, it just doesn't be considered for eligibility.
Matt, those are all really great points that really resonate with me. Just for perspective, lenders are always going to go the happy path. If they can determine using the budget that the association meets that basic requirement today, 10%, tomorrow in January, 15%, they're typically not going to use the reserve study for this test, this eligibility test. Now, they may still ask for the reserve study because they're trying to understand that critical repairs piece that we talked about previously, but they're not going to look at the reserve study just to understand that you've met that 15% in January or the 10% today. And so that's a really good point. And I would agree with you that if they're meeting that 10 or 15%, they're meeting our requirement. But it doesn't mean they're reserving to the level that the reserve study would provide for or recommend. And it is best practice to work with your reserve professionals to make sure that you're reserving in accordance with the recommendations or as close as you can. Because again, the association is going to need that money at some point to make those repairs. And you want to have that money sitting in the bank when those repairs come due so that you can make the repairs and not end up in a situation where you've got a lot of repairs stacking up to the point that they're creating a bigger challenge and that they start to move over into the territory of critical repairs, because critical repairs would make that project ineligible. So always work with your reserve analyst and your reserve study provider to make sure that you're doing what you need to do to set your project or your association up for long-term success. Our basic requirement really is set at a basic level because we're setting policy that has to be able to work in all markets and in all situations, but it may not be reflective of what you actually need when you're managing your association. So great points, Matt. Really appreciate that.
Thank you for that. I think that's very well said.
Yeah. All right. Well, let's talk a little bit more about the budget reserves, because I think folks have a lot of questions about how this works. And this slide really represents the critical points in our policy around budget requirements. It doesn't address dues delinquencies or anything like that. That's a different kind of requirement. We're focused here on the budgeted reserves. And so when the lender's looking at an association's budget, they're trying to determine that it's adequate and that it includes all appropriate allocations for and line items for that project, whatever's appropriate to the association. So smaller associations that have less amenities, their budgets are going to be simpler and have less line items than, say, a really large association that has a lot of amenities. Maybe there's a clubhouse and a gym and swimming pools and other kinds of things that need to be maintained. Well, those associations are going to have much more complicated budgets, many more line items. The lender's going to be looking at that budget to determine that it's appropriate for that project. And then they are going to look at the replacement reserves. And what they're going to look at is your budgeted annual assessment income compared to the budgeted replacement reserve for capital expenditures. They're going to look for a specific line item on the replacement reserves. Occasionally, we'll see a project budget that says, that's a really good budget, and then there's always some profit at the end of the year, and they'll say, oh yeah, that's what we're going to put into reserves. That budget would not be sufficient. We're actually requiring lenders to look for a line item around reserves in the budget. And so they're going to do a quick calculation, and my next slide shows that calculation to determine that it's at least 10%. The budget reserves are at least 10% of the assessment income, and then in January that will be 15%. And if it's not meeting that threshold, and that is a happy path, just looking at those two numbers, lenders are allowed to exclude things from the calculation. And I have the list here on the slide of the things that lenders are allowed to exclude, which includes assessments or fees paid to a master association, special assessment income, the income that's allocated to the reserve accounts, and things that may be paid by unit owners, such as cable fees and so forth. So those things can typically be excluded from that reserve calculation. Lenders are typically not going to do those exclusions if you're meeting that basic requirement, just using your reserve line item versus your budgeted assessment income. That is the happy path. If you're not meeting the requirement even after the exclusions that we talk about here, that's typically when they're going to ask for that reserve study to do a deeper dive to see if they can qualify the association with the information in the reserve study. So when we look at our budget example and how to do the calculation, I just have a quick example here. This is not a full budget. This is just an example. You see that regular assessment income of $900,000. We see incidental income, laundry. A lot of communities have laundry facilities. We see a utility income related to a cable or internet service contract here, 40,000. And so the total budgeted assessment income is 1.1 million here. And then we see that reserve contribution of $150,000. And with no exclusion, so just looking at that annual assessment income, the total income of $1.1 million versus the reserve contribution of $150,000, we get to 13.6%. Now, under today's policy, for the 10% requirement, that would be compliant with our policy. But in January, when we move that up to 15%, that would not meet our requirement. And so the lender would say the project is not eligible to sell a loan to Fannie Mae. And so that's when the lender would go ahead and look at those exclusions. And so when we back out the incidental income for the laundry, and we back out the cable service, and we haven't even backed out everything there, we just are backing out some of those things, we get to over 15%, and then the project will qualify for Fannie Mae loan in January. So that's a real simple example of how that might work with accounting for the total income versus backing something out. Matt, I want to stop there and see any questions, anything else you want to add.
Yeah, there was one that came in about commercial rental income. So I'm guessing they maybe have some guest suites in their condominium and rent them out. Would that be, do you think that would be considered incidental as well, or?
Yeah, that is often incidental income. And so it will also depend on how much the association's involved in operating that amenity or that commercial area. And so that could potentially mean that the lender's including some of that income, but often that sort of rental falls into the incidental income. Now, we do have other requirements, and those requirements I referenced before around non-incidental income. Once that income reaches a certain threshold, that falls into the category of non-incidental income. And once it gets high, that may present some eligibility issues as well. I'm going to switch back a few slides. If you look,
you mentioned
box number 2.
Yeah.
Yep. If you look at our selling guide section B4-2.1-03 for ineligible characteristics, that is the area of our selling guide that you will see the policies around non-incidental income. And so if that is your question, you will find more information there. And at the end of our presentation today, we'll talk a little bit about some other resources. So just keep in mind, sometimes that income can be backed out of the calculation, but depending on the complexity and the amount of involvement, there could be some other eligibility questions that come into play. All right. Anything else here on this slide? Great. Reserve studies, again, we've talked a lot about when they come into play, when the budget test suggests that the budgeted reserves are not adequate. The lender is going to use that. This is just some other requirements around reserve studies. They're going to make sure that it's no more than 3 years old. And that it is prepared by an independent third party that has specific expertise in completing reserve studies. So a lender could not accept a reserve study that's completed by a board member, for example, because that would not be an independent third party. Or I know sometimes there's software out there that helps the board produce its own reserve study. That would not be acceptable for this purpose. We are looking for a reserve study that is an independent reserve study provided by someone with that expertise. And we are also looking that the association is funding reserves that provide financial protection for the project that is at least equivalent to our standards for reserve requirements. And again, starting in August with new loan applications, a lender would not be able to use a reserve study or a reserve amount that is funded at the baseline requirement or baseline funding method when they're seeking to make an exception to our 10% or 15% requirement. Anything else you want to add there on reserve studies, Matt?
We did get some questions about how reserve advisors are adjusting their methodologies, in light of this as well. And I can't speak for all providers, but generally we've never recommended baseline funding for the reasons you spoke about earlier. And I am familiar with some other providers that are now making sure they're not putting in other funding plans into the study that may create a need to do higher funding that may be completely necessary. There are options. We've got lots of webinars and good information about the different funding levels, but that is something we're just being mindful of, to only include really the funding plan that we think is the most appropriate in discussions with the board and understanding that specific association, so as not to create an additional liability.
Yeah, no, I really appreciate that. And we see a lot of reserve studies for lots of reasons. And a lot of times they do have either 2 or 3 funding methods. So they will have that baseline, they'll have the threshold, and sometimes they have the fully funded amount. And so again, we would accept that reserve study, but we would look to make sure that it is funded to that highest recommendation in the study, not the baseline, just because it really doesn't provide the project that long-term financial cushion and protection that is really a best practice in the industry. All right. Last, a couple of other quick things, and then I think we'll talk about resources and open things up for questions. I'm not going to spend a lot of time on this slide, but just to highlight, when we made these changes or announced these changes in March of this year, we also made some policy expansions that will help certain projects. So we have a process that we call waiver review, which is a very streamlined process. They're not looking at a budget. They're not looking at a reserve study. They're looking at just a handful of things, including insurance and critical repairs. That process is eligible for detached units, and it had been limited also to 2 to 4 unit projects. So we see some very small projects that this was used for. We've expanded that process up to projects containing 10 or fewer units. Sometimes we just see those very small projects don't have a lot of documentation that lenders typically need to determine the underwriting. So we've expanded that. We also used to have a requirement that new projects with attached units in Florida required a Fannie Mae approval. This meant that the lender would have to submit a lot of documentation to Fannie Mae and pay fees for that service. That process has been retired as a requirement. So now lenders can do their own delegated review of new projects in Florida. They certainly have the option to submit projects to Fannie Mae for approval, so that they can certainly do that if they so choose, but they don't have to do it. And I think that's a big win for a lot of projects in Florida. And then lastly, for established projects, we used to have investor concentration limits. So that if there was a loan for an investor property, the concentration in investor units could be no more than 50%. We've retired that process as well. So all of these should help reduce friction. And for those impacted projects, it will mean that lenders are requesting less documentation to confirm those requirements. And then the other thing we did were a number of expansions in the insurance space. And this is really reflective of changes that have been happening in the insurance market. One thing that we've done, which I think will reduce a lot of back and forth for associations between lenders, their insurance agents, and so forth, is that we've clarified that we will accept provisions that say extended replacement cost, sometimes we call that ERC, or guaranteed replacement cost, or often called GRC, as evidence for 100% replacement cost. We do require coverage that is 100% replacement cost. So that has not changed. We're just clarifying that we view extended replacement or guaranteed replacement cost as meeting that 100% replacement cost requirement. The other thing that we've done on the insurance side is that we used to have a provision that lenders would have to confirm that there was inflation guard endorsement on the policy. We no longer require that to be validated. Now, an inflation guard endorsement may make a lot of sense and may be a good idea for your community, and you may still choose to have that. It's just that lenders aren't going to be validating that anymore as part of the mortgage underwriting process. One thing that folks are really excited about, and this is really reflective of what we see in the insurance space, a lot of insurance providers are moving to an actual cash value settlement basis for roof surfaces and other personal property and certain property elements, such as, say, awnings or lanais or things like that. We now will allow actual cash value settlement basis, where before that had to be a replacement cost value at settlement. And so that meant a lot of projects were ineligible when they had the actual cash value settlement basis for those amenities or those elements of the property. So with this policy change, those things that will now not cause an eligible problem. Now, Matt, I know this is where a reserve study comes in or can be very helpful, because actual cash value means the insurer is going to look at the age of that roof and only cover based on a depreciated basis. So if that association doesn't have money in the bank to make up the difference, they may have to special assess. I'm not sure if you want to say more about that and how reserve studies can help in that circumstance or not.
Yeah, you're exactly right. When you are saving for that item and its actual cash value, let's say it's 3/4 of the way through its life, you're only going to get 1/4 covered if there was a loss for that item. But ideally, and you should, if you've been saving along with the reserve study, you should have the other 3/4 of cash to make up for that expense. So it's not to put a burden on the owners for a special assessment for that project. But we are seeing some softening of the insurance market. But what I understand, that is very, very cyclical. So while we're seeing fewer insurers going to this actual cash value right now, we expect that to probably be a very common thing again as the market hardens in the future.
Okay. And then the last thing that we've done here is, if it's around deductibles. And so it's most common that we see deductibles as a percentage of the overall insured value. And so, for example, if your insured value is $100,000, we might see a deductible of, say, 5%. And so your deductible is $5,000 in that case. That's a really simple example. None of you have insured value of $100,000. But our deductible policy typically, when it is priced as a percentage of the overall insured value, it is 5%. That is the maximum deductible. But sometimes we see deductibles that are per unit deductibles. So that means they will look at each unit and they'll say for every unit in the project, the deductible is $10,000. And so if there are 10 units in the project, the overall deductible would be $100,000 because it's 10,000 per unit. We now will allow a per unit deductible up to $50,000 per unit. If that is how the deductible is managed through that policy. But when that happens, we do require that there's an acceptable owner's policy in place. That's your HO6 policy. And then the maximum deductible for that HO6 policy can only be the greater 5% of the property insurance coverage for that policy, the HO6, or $2,500. Again, most of the time we're not seeing the per unit deductible, but when we see it, we will allow up to $50,000 on a per unit basis. I'm not going to spend any more time on insurance. I do want to talk a little bit about resources and then open it up for questions because I know we're almost out of time today. So I am leaving you guys with resources. I know sometimes it is tough to talk to your residents about changing, increasing your dues, which for some of you may need to do to meet our new reserve requirements. The condo buyer's guide that Fannie Mae produces, we think about it as a buyer tool, but honestly, it should be the condo owner's guide because there's a lot of information in there about budgeting, insurance, and a lot of the topics we've talked about today. But most importantly, it talks about that shared responsibility that owners have to maintain their project. And I think that's a good tool to use if you're struggling to help owners in your association understand that shared responsibility. So it's a good education tool. You guys can certainly use that. We've talked a little bit about all of our eligibility requirements. And so we have a website that highlights eligibility resources, including FAQs. That can be useful. There's a lot of FAQs out there around critical repairs, and I know we've talked a lot about that today. So that can be helpful. A lot of information. And then lastly, if you are an association that you're wondering, do we already have an eligibility problem for our project? Maybe we have critical repairs, maybe there's litigation or something else. If you're wondering whether or not that's true, or maybe you've even heard that is true, you can go out to the condo status finder. You have to be a board member or a managing agent or some other authorized representative of the association. An attorney, for example, would also work. But we have a tool called the Condo Status Finder where you can set up an account and then you can look up your association. If we have information that suggests you're not meeting one or more of our eligibility requirements, we will return that result to you. We will tell you what eligibility issue we think there is in the project. And through that tool, you can submit additional information and documentation to Fannie Mae to help resolve that issue or provide us updated information so that your project is no longer ineligible. So there are the QR codes. I know Matt and Michelle will provide those after this call today, but you're welcome to use all of those resources out there. And then if you want more information about our selling policies, you can simply do an internet search for the Fannie Mae Selling Guide. And most of our policies that we're talking about today are under the topic of project standards. So that information is available. And then lastly, in terms of resources, we do have training out there. If you are looking at an engineering report and you're going, geez, I don't know how to make heads or tails of this information, we have provided a training module or a set of modules that help folks who are not engineers understand engineering reports. We have made this publicly available. A lot of our training is specific to lenders and not publicly available, but we know how important this is and what a hot topic this is for condo associations and associations generally. So that is a good resource as well. Matt, Michelle, with that, I know we have just a few minutes left. I'm happy to take any other questions or final remarks if you guys have them. Uh, but that is the information I have to share today for the group.
Yeah, we've received quite a few questions. There was a great question asking if a condo can be pre-approved by Fannie Mae to eliminate the need to complete a questionnaire with each sale. Is that possible?
That's a great question. So Fannie Mae, we get a lot of negative attention about projects that are ineligible, and certainly, unfortunately, there are some that are ineligible. But we actually have thousands more projects that have a Fannie Mae approval. Now, today, aside from a lender submitting a project to get pre-approved, we don't have a mechanism for a condo association to submit directly to Fannie Mae for approval. But certainly, once we have information from our lenders about projects, and we also work with vendors to purchase information about projects and do a fair number of our own project underwriting reviews. Once we're able to determine a project meets our requirements, we do approve that project and we make that information available to lenders. They find that information through our tool called Condo Project Manager. It's not something that HOAs can look at or determine that they're already pre-approved. But certainly we do a lot of that, and that's a good suggestion for the future.
Jodi, there were some questions related to states with legislation, such as SERS and Florida, Maryland, and New Jersey both have legislation around reserve studies. And those states specifically mentioned that they can fund via baseline funding. And they were wondering how that kind of compares. And my understanding is these are completely different, right? They of course have to follow or should follow state requirements. So if it says you can follow baseline, you certainly can. If it says you should conduct it every 10 years or every 5 years, that is what you're legally required to do. The difference here is for funding eligibility. And so you guys won't allow the baseline, but perhaps their baseline recommendation might be above the 15%. So if they are funding at the 10 now or 15 later, even if it is baseline, that's okay, right? Because it's the lower of the two. Just want to make sure, because there were quite a few questions around that.
Yeah, that's such a great question. And I'm glad folks are asking that. So if they're meeting today our 10% requirement, or in the future that 15% requirement, lenders aren't even looking at the reserve study for this purpose, right? So that's really the happy path there. Now, state laws may allow baseline funding, and that is okay. We don't have anything to say about state law in particular, except for projects have to be in compliance with state laws. But our lending requirements, as you noted, Michelle, may be a little more restrictive. So state law may allow certain things, but we may have requirements for mortgage eligibility, project eligibility for mortgage lending that go above or beyond what the state law requires. And so when the lender is evaluating it from an underwriting perspective, if they want that mortgage to be sold to Fannie Mae, they are going to be looking at our requirements and applying our requirements, even if state law would allow something a little less.